Hello, hello, everybody. Happy Sunday. All right. Today we're going to talk about risk management. All right, awesome, awesome. So, excuse the lighting. I was trying to stay outside, but I'm in the backwoods in Pennsylvania, and they are shooting outside. They're hunting or something, so it's like a whole bunch of noise. So I'm in here. Hope the lighting isn't too bad in here. Okay. So today we're going to discuss risk management. Okay. And why is this so important? Number one, whenever beginner investors decide that they're going to invest, the only thing they think about is how much money am I going to make, right? And how much and how fast can I make it, right? Uh, Thank you. I just got a message from someone. Thank you. Yeah, and they focus on how much money am I going to make and how fast am I going to make it, right? A lot of beginner investors, they focus on the rate of return and not so much about protecting their portfolio. It's not about how much money you make, it's about how much money you keep, right? And so before we get into risk management, right, let's first define what is investing, right? If you guys see me looking down, I have notes to keep my thoughts organized because I can go all over the place. Okay. So when it comes to investing, according to Investopedia, right, an investment is an asset or item acquired with the goal of generating income or appreciation, right? So you're essentially getting an asset or an item and hoping that the value appreciates over time, right? And obviously, because of that, you're hoping, you're assuming, right? This is not a guarantee. This is not like a savings account. Like in a savings account, you're simply putting in money. You're putting money away in hopes of using it for a future project, right? So it's literally just sitting there. It's not necessarily losing value, depending on what where you're saving this money. Obviously, right? There's always inflation, but let's just say inflation was not a factor. Eventually you're just stacking up money, and then you plan to use it at a future date, right? There's no risk associating with the savings account. You're not risking whether the asset loses value or whether the business that you're investing in goes bankrupt, right? You're not risking the fact that maybe nothing happens. Maybe this asset or this thing that you're investing in just stays stagnant and doesn't lose or gain any value, right? And so this investing is very different from savings, right? Now let's look at some different types of investment. Okay, when people, let's see how fast these comments can come through. Okay, let's do a little game here. What are some investment vehicles or some investments that you're aware of? Okay, I'm gonna give you one. Stocks, right? Everybody knows stocks. That's an investment. What are some other types of investments? Let's see if the comments come through fast. Real estate. Okay, so I saw real estate, stocks, tax liens, right? These are all ways to actually, a tax lien is a way to invest in real estate. There are numerous ways to invest in real estate. You could do foreclosures. You can do tax liens, probate, right? These are all types of investment. Believe it or not, paintings, right? Paintings can appreciate value over time. A lot of the wealthy actually invest in art. Okay. Another thing that others don't think of are Jordans, right? Sneakers, anything that can appreciate value over time. Businesses, right? Essentially, when you're investing in a stock, you're essentially investing in the business. You are becoming part owner of that business, right? So you can invest in a business in many different ways, whether that's through stocks, whether that's through corporate bonds, right? Whether as an angel investor, right? Whether it's through crowdfunding, there's numerous ways to invest in businesses, right? Any other ones that I didn't mention? No? Okay. All right, cool. So we're going to move on to, we're going to go backwards to the initial definition of investing, right? You're buying an asset, you're acquiring an asset or an item, right? In hopes, keyword in hopes, that the value goes up over time. Now, with that being said, that incorporates some sort of risk, right? The very definition of an investment actually implies risk. You're taking on the risk that this asset may appreciate over time, may gain value over time, right? And so that leads us to our topic. How do we manage our risk? What are some ways that you guys can think of to manage your risk? Waiting for some comments here. Anybody? Some ways that you can manage your risk. Whether that's through real estate, whether that's through stocks, whether that's through crowdfunding, diversify. Exactly. That is actually one of the things we're going to talk about. Why is diversification such a good tool to manage risk? We're going to get into that. Well, when it comes to managing risk, there are two main ways to do so. Okay. Number one is diversification, right? My entire master's in finance program, literally, that's all they drilled into our brain was diversify, right? The second way is go in with a plan. All right. Actually, I have a quote for you here. It says, know when you'll get out before you even go in. Okay. I'm going to repeat that for you. Know when to get out before you even go in. That means you want to have an exit strategy the minute you decide on your investment, right? Whether that's real estate, whether that's art, whether that's Jordans, whether that's a business, stocks, mutual funds, bonds, whatever it is, you want to know exactly how much money you're looking to make and how much money you're willing to lose, right? And so that means you want to have an investment plan, okay? So you want to have an investment plan and you want to diversify. Those are the two main ways to manage risk. So now let's dig a little deeper into diversification. We're going to start with diversification because that was the first answer here, okay? So why is diversification so important? Well, it goes back to the age-old saying, you don't want to put all your eggs into one basket, right? Imagine you have a portfolio of about, I'd say $100,000, and you decide to buy only Apple stock. If Apple were to tank, or whatever the case is, Apple tanks tomorrow, you are completely out of your whole $100,000. But if you put a little bit, maybe $10,000 of your $100,000 into Apple stocks, another $10,000, maybe you put down on a duplex, right? That'd be your down payment on a duplex. Maybe you put another $10,000 on an up and coming startup, right? Maybe you put another $10,000 into mutual funds or ETFs, right? Another $10,000 into bonds, right? And you have all these different asset class. Another $10,000 into paintings and art, into Jordans, whatever you want, right? And you have literally 10 different asset class within your portfolio. Let's say the entire stock market goes down. That's only 1 out of 10, 1/10 of your portfolio. $90,000 is still doing its work. It's still protected. It's still increasing value, right? Let's say both the art that you invested in and the stocks that you invested in, the painter turned out to be a fraud and that's not really his work, and there goes all the paintings in your portfolio. You still have $80,000 to work with, right? Let's say the real estate market completely crashes and your duplex is worth absolutely nothing. You still have $70,000 to work with, right? Literally, for your portfolio to go down the drain, all 10 of your asset classes would literally have to tank for you to completely go down to zero. right? And that's just an example. Maybe you don't do the $10,000 in each asset class, right? Maybe you do $20,000 in one asset class and 80,000 in another, or 30,000 in one, 30,000 in one, 30,000 in another, and then 10,000 in something else, right? You want to determine your risk profile. Okay, so go ahead and determine your risk profile, meaning how much are you willing to lose out of your $100,000, and then rank each asset class from risky to less risky. Okay, so maybe you're super risk averse and you're like, I'm conservative. I just want my money to make money. I can't afford to lose not even a penny. Well, you shouldn't be investing, but that's besides the point, right? So if you're super risk averse and you're looking for super conservative things, maybe stocks is not the right, shouldn't be in your portfolio at all, right? Maybe investing in startups shouldn't be in your portfolio at all. Maybe you want to invest, if you do want to invest in businesses, maybe you want to invest in established businesses that that already have a history of income, right? That are in a safe industry, right? So you want to take a look at all of those things. Take a look at your profile, your risk profile. Look deep within. What am I willing to lose and how much money do I want to gain? Okay. So let's say you're super risky. You're a gambler, right? You like, hey, it takes money to make money. Scared money don't make money. Maybe that's you, right? Maybe you can afford to have a huge chunk of your portfolio in stocks, right? Maybe you can afford to have a huge chunk of your portfolio in startup businesses and taking a chance on a whole bunch of businesses, taking a chance on painters and artists that are just up and coming, and you're looking to get that next game, right? You have to first determine your risk profile. Most people are right in the middle, right? If you're in the investment world, you have some sort of risk tolerance. Very, very, very rarely do we find people in the investment world that are super like, hey, I don't want to lose a penny. Because in that case, then a savings account is probably your best bet, right? Or maybe a money market account, or government bonds, which are historically, they have been on the safer side of investing, but there's still risk. Every type of investment, like we talked about in the beginning, every type of investment is going to have some sort of risk, okay? So now that you've determined your risk profile, now you want to develop a trading plan, an investment plan, okay? And remember, you're dealing with money here. Just like, there's a plethora of blogs out there. There's a plethora of YouTube videos, all types of information, how to budget your personal finances. How to allocate to food, how to allocate to rent, how to allocate to, cable, whatever the case is. You want to treat your investment portfolio the same exact way, right? You want to come up with a plan, a budget per se, right, for your investment portfolio. So you want to have a determined, a predetermined risk, right? So what I recommend, and most investors do, most financial planners, advisors, coaches, they recommend to risk 1 to 5% of your entire portfolio value. Okay, account value, if you just have it in a brokerage account or in a 401k or in an IRA, whatever the case is, wherever the investment money is sitting, whether it's an escrow account, whatever it is, right? You want to risk 1 to 5% of the entire portfolio per investment that you make. Okay, so let's say you're on the more risky side, right? So your number would be closer to 5%, and you're sitting on $100,000 that you want to invest. All right, so 5% of $100,000, if I'm not mistaken, is 5,000, right? Where's my calculator? I don't want to give y'all the wrong math, right? Yeah, 5% of $100,000 should be 5,000. Let's ask Google. What's 5% of $100,000? Just to make sure. I want to make sure I'm giving you guys the right amount. Oh, it's $500. Sorry. See, I'm glad I pulled out the calculator on that one. Right? So every investment that you make, your risk tolerance will be $500. That means that you're only allowed to let yourself lose $500 on that particular investment. All right. So obviously this is this is a general rule of thumb. Okay. You don't want to sit here and say, oh, Katiana, I saw her on Crowd Wall Street's Live and she said 5%. This is what we recommend. Because remember, we're also recommending diversification. Okay. So that means you're going to have different asset classes in your portfolio as well. So that $500 is not just the entire, like, oh, well, I can't buy this house because I could possibly lose $500. No, that's not what we're saying at all, right? You want to do 1 to 5% per asset class per investment. Okay. So let's say you were to trade about half of your portfolio in stocks, right? So each investment that you make, let's say you decide to buy Tesla, right? And you buy a couple of shares of Tesla, you want to make sure that you put in the stop loss orders to where you're only losing a maximum of $500 on that investment. Okay, I hope that makes sense. So that would be your target loss. Now, obviously, with bigger types of investments, like something like real estate, that's not a stock that you can buy for $300-$400 a share like Tesla, right? Real estate is going to require $10,000, $20,000, $30,000 down. All right, the calculations will be a little bit different, but the idea still remains where you have a defined risk. Okay, in the case of crowdfunding or venture capitalists, right? If you want to invest in a startup or you invest in a business, other than stocks, because stocks is investing in business, but if you want to lend money to startups, or you want to be an angel investor or a venture capitalist, you want to make sure that you already have a defined risk, because there's going to be some of those businesses in your portfolio that are not going to make it. That is the essence of investing. Just like real estate, there are some properties who are going to lose value, right? Let's say you're doing income property investments, right? You're buying duplexes or apartment buildings. There's going to be some of your renters who don't pay rent on time, right? That destroy the property. That comes with the whole picture of investing. So you want to be ready for these things, right? You want to incorporate these losses before you even get in. If you're the type of investor who says, I'm going to buy this building and I have 10 units in this building and I cannot afford for one of those units to pay me late, you should not be investing in that building. Right? So if you're going in and you're buying a real estate building, an apartment, a real estate building, that's the same thing, right? If you're buying an apartment building, okay, and you may want to set aside about 4 to 5 of those. Wait, if it's 10 units, that's a little much. Maybe 2 to 3 of those units may pay you late, and be ready for that. Have an emergency fund of some sort, or whatever the case. Be ready for it. Okay. Maybe you're investing in art, in paintings. All right. Maybe you have 10 paintings. Be ready for about 1 or 2 of those paintings to never really gain any value or even lose value. Okay. So that goes with any type of asset class. You want to have a target loss. And also that brings me to the next point. You want to have a target profit. Now, why is having a target profit just as important as having a target loss? Right? This is what happens. This is what I see. Because I didn't get to talk about myself a little bit, but you'll get to know me. You'll get to see this face almost every Sunday. You'll get tired of seeing me, but you won't get tired of the information that I bring. This is what I see in a lot of my students, because I teach beginner stock market trading. A lot of my students come in and they want to buy Apple and they want to buy Tesla because they want that fast return, right? They want to buy it and see what happens. Like, oh man, if I had got into Amazon, 10 years ago, man, I would have bought it at $5 and now it's, in the thousands. I would have made so much money, right? It's all hypothetical stuff. It's not defined, right? So if you want to go and buy Apple and just hold on and see what happens, well, you're going to see what happens. You're going to see a whole lot of what happens. You're going to see Apple fall down, go back up, stay stagnant for years. You know what I mean? You're going to see a lot of different things. And what's going to happen is your emotions are going to go through those whole roller coasters as well. right? But if you go in, right, with a plan saying, okay, I'm going to buy Apple stock. And when I hit a profit of $500 or whatever your target profit is, let's say it's $200. Let's say you just want to make $1 because you just wanted to make an extra dollar. I don't know, right? You determine that, and once it happens, you get out, because what happens? This is what happens. The stocks, the investments, everything, real estate, everything goes up and down. That is the nature of everything in this world. Everything goes through a cycle. What goes up must come down. What goes down must go up, right? And so you're just gonna ride that roller coaster, and you're gonna become emotional, and that's when the decisions are gonna start getting blurrier and blurrier and blurrier. And next thing you know, you blow your entire portfolio because you were making decisions based on emotion and not logic. You didn't come in with a plan, right? Because you didn't come in with a plan, you got eaten alive by the market. Eaten alive by the investment itself. You let the investment control you instead of you controlling the investment. Okay. So let's say you want to invest in, let's say you have about $1,000 and you want to invest in about 3 Black owned businesses, up and coming Black owned businesses, right? And you decide, okay, that $1,000, I want that $1,000 to make me an extra 500. Right? So you're going to go in, you're going to allocate your funds accordingly based on your risk tolerance and your calculations and everything, right? And then when business one makes $150, you get out. Okay? It doesn't matter, because there's always that FOMO, right? That fear of missing out. Like, oh my God, if I had held on a little bit longer. Nope, that was not your plan. Because if you had held on a little bit longer, the stock or the business or the real estate or whatever it is you're investing in could have went the other way as well, right? Stick to your plan. You want to make $150 on your investment, get out once you make $150, because guess what? You can go right back in. There's always an infinite amount of opportunities to go right back in. Okay. Let's say you want to double. Let's say you got $1,000 and you want to double that, right? And you decide you're going to invest in, I don't know, art or whatever the case is. I keep giving those same examples. You guys can chime in and give me some other examples to talk about. But in the case of investing in startups, let's say you made your 1,000, you put it in a business goes well, right? Business is booming, and you made your 1,000. You get out, because guess what? Now you've made your money back, right? You've doubled your money. Now you can take that initial 1,000 that you have, put it somewhere else that's probably a little safer, and then use house money, because that extra 1,000 that you made was house money. And now you can gamble. You can gamble, right? Freudian slip. I mean, we're talking about risk, right? And now because I was talking about house money. You take that house money and now you're using free money. This is free money. Your $1,000 made you that $1,000. You didn't have to go clock in for no one. You didn't have to, drive to go to an appointment. You didn't have to do nothing. For that $1,000 went to work for you. Okay. So, and that's what it brought home to you. That profit, it brought it home to you. So now you can use that money and put it into even more startups. Because guess what? If, let's say, one of the startups makes you lose 500, you still gain $500, and your $1,000 that you started with is still parked somewhere else, right? So you always want to live to invest another day, right? Have your target profit, take small increments of wins, stash them up somewhere that's a little safer, right? And if it's already in a safe investment, you could stash it into maybe a savings account or a money market account or somewhere where there's very, very, very little risk, right? Stash it somewhere else and keep grabbing your wins, right? It's kind of like an apple tree. Online savings, yeah, exactly, right? It's kind of like an apple tree. You plant an apple tree, you grab some apples, right? You might use some of the rotten apples and put them back in the dirt as like food. Higher interest rate. Yes, exactly. You might take the apples and put them back in the dirt because, that's more nutrients for the tree to continue to grow. Grab some apples, maybe make some apple pie, right? Maybe freeze them. I don't even know if that's a thing, but whatever the case is, right? You want to grab your profits little by little. It's much better to make $1,000 in different increments than to just make that one win that gives you $1,000, because that one win that makes you $1,000 could have been that one loss that lost you $1,000. But if you made $1,000 in increments of 200, even if one of those was a loss, you only lost 200 instead of 1,000, right? Let me say that again because that was actually a good point. If your target profit is $1,000, right, it's much better to grab them in smaller increments than to just grab that one win, because that one win could have been that one loss that wiped out your entire portfolio as well. Okay, so now I talked about how coming in with a plan. The third thing about having an investment plan is you want to have an accountability partner. Okay, what do I mean by that? A lot of times we overestimate our discipline. We define our risk tolerance. We come up with a plan to stick to that risk tolerance, and then we tell ourselves that we're going to be disciplined enough to follow that plan. Yeah, no, that's probably not going to happen. 99% of the time, it's not going to happen, right? Unless you've already been doing this for a few years, right? And even me as a mentor myself, I have a mentor that keeps me in check. Like, hey, Katiana, why did you get into that trade? That's way more than 5% of your portfolio, right? No matter how much money or how much knowledge or how much experience you have, you always want to have a mentor or an accountability partner. Some of you guys, this may be your spouse. Some of you, this may be a best friend. This may be a group, an investment group, right? This may be an advisor of some sort or a few advisors, right? You don't want to just have one person telling you what to do with your money. You want to have a team telling you what to do with your money, just like you have a team telling you what to do other things as well, right? And so you always want to have some sort of accountability partner that's going to help you stick to your investment plan. All right. The last thing I'm going to touch on is diversification, which I already kind of talked about, but diversification pretty much sums up the same idea of taking smaller increments of wins, right? It's just a way of minimizing your risk, right? It's okay. Let's say you're just doing stocks. Okay, let's just say you're just doing stocks. You're not doing anything else, no real estate, nothing else, right? You don't want to just put it in one company, right? Because that one company goes bankrupt, there goes your entire portfolio. You don't want to put it in just one industry either, because remember the economic cycle and the business cycles, right? There are some times when the economy is great, certain industries are doing well, and when the economy is bad, other industries are doing well, right? So if you think about it, what are some companies that you think are doing well when the economy is doing well as well? What are some companies? I'll give you guys some time to think, and also think about what are some companies that are doing well when the economy is doing bad. Okay, think about that for a second. I'll give you about 13 more seconds. Think about that. Okay. So I don't see any answers, but some companies that may be doing, some industries that may be doing well when the economy is doing well are retail, right? People have more money in their pockets, job rates are great. People are making money so they can spend it on frivolous things, right? Transportation, people are traveling more. They're enjoying their lives. Exactly. The auto industry, people are buying cars. That's why, all those car dealerships, you see a lot more commercials for cars during tax time, because they know people have money and they want to splurge, right? Now, when the economy is not doing so well, there are still industries that are going to do well because the economy is not doing well, right? Companies, industries like healthcare, right? More people, especially now in a pandemic, right? More people are going to the hospital. Telemedicine is getting bigger, right? Any type of virtual doctor apps and companies, those companies are thriving. Vaccine companies that are working on a vaccine for COVID, right? These are industries that are doing very well. Utility companies, right? Like General Electric, any type of utilities, because people are home, they don't have nothing else to do, but they got to pay those bills, right? Some food companies. So that would be some grocery stores, right? Walmart's, Costco's, right? These are companies that Publix is actually it's not publicly traded, but you can still invest in Publix, if you meet those requirements, right? And so these any type of supermarkets, people got to eat. They're not eating out as much, so they're cooking more. So they're going to the grocery store, and a lot of times people are bored. They have nothing to do, so they go to the grocery store and buy some snacks, right? So these companies are actually thriving during the downturn. This is where diversification becomes important, because now you can survive different turns in the economy, right? Different cycles in the economy. You don't want to have your portfolio in just one industry. I know right now the tech industry is probably the most exciting, the most sexy, right? And everybody wants to invest in the Apples and the Teslas and the Amazons and the Googles, right? That's all they think about. But even though Amazon is doing very well right now, but there are times in the economy where tech is not the place to be, right? And so if you have another portion of your portfolio, maybe in energy or oil or gold or metal, right? Now maybe that portion of the portfolio is doing good, right? Also, if for example, you have another portion in your portfolio that's in real estate. Maybe real estate is not popping right now, right? But stocks are popping. Okay, so your portfolio is doing good. Maybe another time real estate is popping and stocks are not. Same thing with bonds. All right, so you definitely want to have different asset classes in your portfolio. Okay, so that's about it for my notes. Just to wrap it all up, okay, the first point was the definition of investment, right? You're acquiring an asset or an item in hopes that the value goes up over time. And because you're hoping and you're assuming, right, you're forecasting, these are all assumptions. It is not definite that this will happen. It implies risk, right? Some of the risk is that the value of the asset doesn't go anywhere, it just stays there. The value of the asset actually goes down, or the company goes bankrupt, or there's a pandemic of some sort, or whatever. There's risks associated with any type of investment. And two ways to mitigate your risk is, number one, diversify. You want to have different asset classes in case one of those asset classes is going through it. Your portfolio is still withstanding, right? Or maybe even two or three of those asset classes in your portfolio are going through it, but your portfolio is still intact, because guess what? You have multiple asset classes in there, right? And then the other way to mitigate risk is to go in with a plan. You don't just want to buy something and see what happens. You don't just want to invest in a startup and see what happens, or invest in a even an existing business and see what happens, right? You want to go in with a plan. I'm going to make $200. I'm going to make $200,000. I'm going to make $1, right? And once you make that, you get out. And you also want to have a defined risk. I am willing to lose X amount of my portfolio, okay? And if that gets to that, get out. Do you live to invest another day, right? You can get out and collect your emotions, because this can be an emotional game. Collect your emotions, get yourself together, and go back in at another time. Whether that's stocks, whether that's art, whether that's Jordans, whether that's anything really. That's a startup, of real estate, whatever it is. All right. Any questions, guys? That's pretty much it. I'm gonna wait for questions as they come in. Comments, concerns, examples, anything I left out, anything anybody want to add? Okay. All right, so I don't see anything. If I don't see your question right now, I will read through the comments once this is posted, and I will answer them through the comments. But that's it for now, and I'll see you guys on the next. Okay, almost. How to find an industry to invest in. Okay, so when you ask how to find an industry to invest in, that can be okay. I'm actually gonna, before I ask that question, I'm gonna answer it in multiple different ways. Number one, you want to define what it is you want to invest in. Are you buying a stock? Are you purchasing a bond? Are you doing a mutual fund? Are you doing an ETF? All right. Are you purchasing an item? Are you purchasing a building, right? Or an equipment or whatever it is, okay? And then you want to determine what is going on in the overall economy. You want to look at the bigger picture of the economy at that very moment that you're making your investment, right? And you want to determine how much money you're willing to make on your investment, okay? So let's look at an example. Let's say you have about $10,000 to invest, okay? First, you want to look at different types of investment you can make with 10 grand. Okay, so that already X's out a lot of different things. All right. Maybe you want to buy a property cash and you don't want to finance it. You may not be able to buy a property cash with 10 grand. Actually, you could. There are places where you could buy a whole property for 10 grand, but that's another live for another time. But maybe you want to look into land, maybe something international, right? So determine how much you're starting with. Okay. Determine how much you're willing to lose, determine how much you're wanting to make, okay? And then look at the overall economy. What's going on in the world right now? And the time frame that you give yourself to make the money, right? What's going on in that world? Like 4 or 5 years from now, what is the world going to look like? You can make an assumption, but what is the world looking like right now? Okay? So that'll give you a good place to start. So that $10,000, maybe you're giving yourself 2 to 3 years to have that $10,000 double. Okay. So now maybe real estate may not be the right thing for you because we don't know that $10,000 is going to double within 2 to 3 years. Right. Okay. So you probably want to look for an industry that's going to give you a faster rate of return, but then that comes with risk as well. So you want to determine your risk. Okay. So I hope that helps. You want to first, so to answer your question again, number one, you want to start out with how much are you starting with? How much are you investing? Number two, how much are you willing to lose? How much are you wanting to gain? And look at the overall economy. What is going on right now? And does this industry that you're thinking of fit those investment goals? Okay. I hope that answered the question. Any more questions? Awesome. All right. So another question that I usually get from students is how do I know how much to start with? Okay. I don't know if that's your question. Any of you guys have that question, but you want to know how much do I want to start with? I can answer that the same way I just answered that last question. How much are you willing to make? Willing to lose. How much are you looking to make? And what is going on in the economy overall? Actually, that can answer a lot of starting questions. Any type of questions with where do I start? You want to look at how much money you're willing to lose, how much you want to gain, and what is going on in the overall economy. Okay. And a lot of you seasoned investors, because not everybody here is a beginner. Some of you guys are like, all right, I've heard this before, right? Look at your past portfolio performance. What were some of the industries that gave you the highest return, right? That they gave you the more consistent returns, right? Because sometimes highest is not the goal, because you could invest in a startup, right? That literally just becomes the next Facebook, and that gives you the highest return, but that was also the highest risk because they didn't have any past data to help you make a sound decision, right? Or you can invest in an established business that's been in business for 10, 20 years and is consistently paying you dividends or consistently giving you a check every month, right? So you want to look at your past performances to determine your next business venture, or your next investment venture. Okay. Okay. I was reading the comments here. Okay, any other questions? I'm going to give you guys another minute. Come up with any other questions, comments. Okay. So the name of the game is risk management. Don't go in without already having an exit strategy. Okay. All right. Awesome. All right, guys. That's it for today, and I'll be back. I don't know, next Sunday or another Sunday with more topics. Actually, next time I'm gonna do like a PowerPoint so you guys can follow and take notes. All right. All right, guys. That's it. Bye.